Okay.
All right, everyone. Without further ado, I'm going to introduce our first guest speaker, Mr. Christopher Chow. He's joining us today from Westpac Wealth Partners and is a certified wealth manager and financial advisor. He's born and raised in Hawaii. He's a member of FinSECA and works with helping industries such as medicine, military, as well as business owners and real estate professionals. And we're thankful to have him here. We also have Miss Roxy Kiesling. She's also joining us from Westpac Wealth Partners and is also born and raised in Hawaii, which is cool. She has a passion for helping girls and women with her work through the Organization of Women and Girls and the Rotary Club of East Honolulu. She's also a certified financial advisor. So we're very thankful to have them here. They're going to help enlighten us on how to be our own banker. I know lots of people in the real estate industry right now are interested in creative ways of financing property. Interest rates are high, so everybody's looking for that, new idea as far as how can we get money to purchase real estate. And so they're here to help kind of show us how we can use that through life insurance. So with that, I'll go ahead and turn it over to you guys. Welcome.
Hi, nice seeing everyone. A lot of you are joining us from the morning time. It's just started in the afternoon here in Hawaii, and we're happy to have this opportunity to just spend a little bit of time to share some information. Of course, the reality is there's no way that we're going to be able to share everything with you guys today. And so we will always make ourselves available to you guys if you have further questions, want to take a closer look at your current situation and how this may fit into your overarching plan. We're always happy to take some time and do a Zoom and make sure you feel comfortable with that. So, again, I think first and foremost, thank you all for your service. And my grandfather served in the Marine Corps for 20 years. He was part of that greatest generation that ran away from home and to join the war in World War II. And he passed away at 98 in Okinawa in 2022. He outlived all expectations, also served 27 years as the AAFES distribution head district manager of the Pacific Rim for 27 years. And it's very near and dear to my heart, and I know the sacrifice that families and all of you guys make to be able to serve our country. So thank you for that. Uh, Today we want to just talk a little bit about um, some basics as we get into life insurance topics. We're going to basically go into a crash course of like life insurance 101, 10201, and probably won't have too much time to go into 301, which is where some people want to really talk about technicalities on leveraging your life insurance policies. But again, we'll give you the basics so that you can start understanding the basic concepts of how that might work. So, at the end of the day, the reason why people talk to us is as individuals, as family members, we all have common goals. And we always want to make sure when we're talking with families that goals and having it written down are important, but we don't want to confuse goals being numbers and numbers being the goal, right? The goals that people really have when you unpack and peel the layers off the onion is that they want to provide this sense of security, confidence, and clarity for themselves, their family, their financial situation, so that they know that regardless of what happens, they're headed in the right direction. Life is never as planned, right? You get in for all loops and things along the way. And a lot of other things, just as we've seen, especially in the last 5 years, can turn our world upside down quite literally. But there's so many different variables that come into play. So when we start looking at someone's financial situation, we always have to start from the fundamentals and basics. And before we can make any recommendation on what tool, financial instrument would be best for someone, to understand what led to someone to get to where they're at today, and where do they want to go for the future. And that way we can't undo the past. Past is a past, but we can learn from the past. And then the question is, now that we know what we know, how can we empower ourselves to move forward into the future? So Roxy, perhaps you can talk a little bit about just the fundamental basics of where understanding someone's financial situation starts?
Yeah, so the first thing that we want to do is just get financially organized, right? Get that lay of the land. What sort of decisions have we made in the past? What do we look forward to? And so that starts with just our traditional balance sheet, right? So I'm not sure if it can click through on your end, Chris. There we go, right? Assets, what we own versus our liabilities, what we owe. And essentially that's going to equal your net worth. And net worth is important to look at, but it's not the only thing when we're trying to make smart financial decisions. So we also added in another domain, cash flow, which is really the foundation to our financial world, right? It's what's going to fuel all of our goals. And it's really understanding how does money work, right? So we got a lot of feedback. We know a lot of you are interested in learning more about cash flow, right? How much do we bring in, whether it's active, whether it's passive income, what amount of that is going to go towards protection to be sure that we always have that income? What amount should we be saving? How are we managing our debt efficiently, right? How are we managing our tax liability, not just for today, but what does that look like in the next 10, 20, 40 years into the future? And then, of course, enjoying our lifestyle. So if cash flow is the foundation, right, our assets are like the walls and belongings in our home, and we're building this financial house, it only makes sense that we put a roof on top to protect everything that we're working so hard for, right? And this is just looking at drawing the line in the sand today, knowing we're never taking any steps backwards. We know we can spend years and years of hard work to build our assets, right, to grow our money, but it only takes one instant to have that all taken away. So really protecting against any liabilities, disabilities, or the most extreme, a premature death. And now that we're able to look at our picture, right, our financial world in this holistic view, that really allows us to get clarity, and then we can start highlighting those different opportunities that come up. So this is really the foundation for everything that we want to do. And today we're going to focus specifically on, again, how can we build wealth efficiently? How can we leverage certain financial vehicles out there so that we can continue to build our passive income? So we know that Wei was able to give us some feedback about what you all are most interested in learning about. And before we can dive into this topic of being your own banker, we do need to address one of the beginning steps, which is being a great saver, right? We can't invest, we can't leverage, you really can't do anything without saving first, which unfortunately this has become somewhat of a lost art. And we can use the chat here, but how much do you guys think the average American household saves annually as a percentage of their income?
I would guess like 10, 20%.
Yeah,
Oh,
I'll
that's
do
very
the same 5 to 10, no more.
Yeah, well, we want to be working with the people that are saving 10, 20%, but let's just take a look and see where we are. So we actually were recently answering this question just a couple of months ago, and it was about 3.6%. As you can see today, it's closer to that 3.2%, so even less than 5%, which we saw right a couple of guesses there. And if we were to just look back to 2020, right, we peaked there at 32%, which is great. But historically, over time, right, what our parents, what our grandparents were saving, we were really saving closer to only 12% of our income. So really want to focus, right, on first getting that savings rate up. Optimal for us would be saving at least 20% of your income. And that's really what's going to make all the difference in our financial future, right? And once we are able to be saving at that rate, then we can figure out, okay, where is the best place to actually be parking this? We know that not all places you save are going to be equal, and they're not going to give you the same possibility, right? So we want to understand liquidity, how easy it is to access those funds. We want to think about how do we diversify across a time horizon, right? As you can see the little piggy banks here. We want to think about, okay, if we need this within the next 1 to 2 years, we're really looking at the short term. Outside of that, right, maybe we want to buy more real estate, or have goals of starting a business. Maybe that's 5, 10 years out. That'd be our midterm bucket. And then even farther out, when we think of retirement, right, long term, 15 plus years, there isn't one best vehicle that's going to be able to do it all for us. It really depends on what we want to do. So some of the common investments that we see, right, when we're looking at, okay, what can we utilize to efficiently grow our wealth? We start with just cash, right? Cash equivalents. These are like your bank checking and savings accounts. From there, when people start thinking about how do we get higher interest rates, we can look at fixed income or bonds. Then we maybe want to move to investing and having ownership in a company with equities or stock. We know a lot of you are interested in real estate and diversifying with that. So that could be anything from commercial to residential to having partnerships or syndications, or even just real estate funds. And then, of course, outside of that, we even have alternatives, right? So things like crypto, private equity, precious metals or commodities, many different vehicles that we can use because, again, there isn't one that's going to be the end all be all for efficient wealth management. So based on this feedback about being your own banker, right, to fully understand this, we want to understand the main tools that we have available. And often this idea ties back to an insurance protection product and leveraging it for wealth creation. So Chris will actually, dive in here and give us some framework of insurance and protection and how this relates to you being your own banker.
All right. So, why does things like permanent life insurance make such a good tool for building assets, building wealth, generational wealth, as we've seen it done in real life? And it all has to do with this concept that every person who's on this journey of wealth building is on two parallel paths that they're managing. One, again, as Roxy mentioned, is this protection, making sure that we're not going backwards, making sure that we're drawing the line in the sand so that we can never wash away all the hard work we have. And we're trying to protect against those things that Roxy mentioned: death, disability, lawsuit. And then it's about figuring out how do we figure out the right type, the amount, and where do we position it in our financial world. And that's all along with the same concepts that Roxy talked about with this wealth accumulation. We have different capital needs for very different purposes. And again, they all intersect together when you're younger, right? That's this wealth accumulation curve. They're all put together, and protection is much more important in the beginning. And later on, your assets ideally have taken the time to grow and become really significant. To at some point, you'll reach your optimal wealth creation at some point X in the future. So that's really where the insurance companies go, is they say, do you want the guarantee of getting to 95% of your potential wealth, or do you want to roll the dice? Like if you're in Vegas, do you want 100% of X with the likelihood of potentially less than 50% of X? Or would you rather just have 95% of X? Right? It's a good thought to have. And that's really where life insurance and protection comes into the wealth creation process. Most people really don't end up being able to see it in that perspective. Imagine if you could go to the casino, and instead of a blackjack where you have like a 451-49, you had a 95% chance of winning every hand. That's what we're talking about here. So when we're looking at life insurance, we're always going to have to peel it back and say there's always two questions fundamentally that we have to go into. What do you want life insurance to do for you and your family? And that really is a conversation about really being on a spectrum. It could be purely just as a wealth creation, wealth management tool. But the reality is most families, as time goes on, is they develop different philosophies. They might want it to cover burial expenses. That's where you see people get like these tiny whole life policies from the credit union or, American Income Life, something like that. Some of them want to make sure all our debts paid off. We don't want to leave any VA home loans. We don't want to leave any auto policies, student loans, anything like that. Others want to go a step further and they want to make sure they leave behind a number of years worth of income so that their family can, number one, get back on their feet emotionally, and also figure out financially how to get back on their feet. And then we start getting to the levels of wealth creation, where you're thinking about education, maybe your parents. Some people have aging parents, they know inevitably they're going to have to be involved in it. If they were no longer around, who would take care of them? You have a spouse, you want to work towards retirement with a spouse. I'm sure you guys have seen, when you're a single parent, you can't save the same amount. You don't have the same amount of time as when you're in a dual parent household. So making sure something's left behind so that your spouse will eventually be able to retire. And then others have some charitable inclinations to church, foundations, things like that, until you get to this maximum concept that someone has. You can't be overinsured. It's a uncommon belief, but unless you lie on these applications, you can't be overinsured. So then we get to the kind of the meat of everything. What types are there and what type is optimal for your situation? So maybe Roxy, you can just walk us through the two major types of insurance most people encounter, and then we'll kind of dive a little bit deeper into permanent life insurance and where that comes into play as a wealth tool.
Yeah, so there are really two major types of life insurance out there. That first type is going to be term. It's temporary, it's pretty straightforward, and it's what most people think of when they think of life insurance. It's in the simplest type of coverage. And term insurance is temporary, so it's only going to cover for a certain period of time. You may have term coverage through your employer, and the term is going to be for however long you are working with them. If you look at term insurance outside of your employer, usually we're looking at it for a set number of years. As you can see here, 10, 15, 20, or 30 years. And you have this protection in place so that if you pass away in that time period, your beneficiaries would receive a death benefit in a lump sum tax-free. Now, this provides very valuable coverage, especially if we have financial responsibilities, right? A lot of those things that Chris went through on a couple of those slides back, right? But the question then becomes, okay, what happens if I outlive this term? Well, the insurance company then gets to keep that premium and your coverage ends, which is really the best case scenario, right? We don't want to be using this and really provides a important piece of coverage. So that's term. And now if we hop over to permanent, it's different from term insurance in that it's never going to expire. So we have two different types that we break down even further. The biggest difference is the fact that permanent insurance, besides a death benefit, it also has a component to it called cash value. So cash value is very similar to equity in real estate. When you purchase real estate, you take out a mortgage, and as you pay that mortgage down, you build equity. And that's going to represent the ownership that you have in that property. You can then use that by either selling the property or borrowing an equity line of credit off of the home. And so similarly with permanent life insurance, it has equity, and that's just what we call cash value. So on the left-hand side, right, we can see universal life. This is really a newer product on the market. It was developed as an answer to extremely high interest rates in the late 70s and 80s. And the way universal life policies work is when you pay the premiums, a portion goes towards that death benefit or the cost of insurance, and the other portion is going to go into that cash value account. Now, the cash value account, it isn't just going to sit there, but it's going to receive credit in some form of interest, depending on what type you have. So you can see listed out there, there's fixed, variable, and index. So with the fixed universal life products, that cash value is credited based on a fixed rate of interest that's going to be declared by the insurance company. Now with index universal life policies, that cash value is based on the performance of usually a specific major stock index like the S&P 500 or the Dow Jones. And then lastly, we have variable universal life insurance, which the cash value is invested in the stock market. in some sort of underlying investment option. And then as a result, the interest credited will fluctuate over time. So one important thing to note is that there is, as you can see in bright red, no guarantee on the cash value. And you're probably wondering, okay, how is it possible that I could go to zero in these policies if I'm being given a fixed credit? And the answer is in the structure of it, right? So when you are young and healthy, the cost of insurance is very low. And then as you grow older, the cost of insurance is going to continue to increase. And at some point, when you get near your life expectancy, the insurance costs can be so high that they surpass the amount that you're actually putting into the plan. And at that point, you then have to decide, okay, am I going to put more premium into this plan, or am I going to have that start to be paid out of the cash value? So oftentimes we see, right, over time, as the cost continues to grow up, we start to see the cash value decrease, and sometimes you can be left with little to nothing in that cash value portion. Now, on the flip side, we have whole life, and it's different from universal life policies for a number of reasons. Usually, whole life is coming from a mutually owned insurance company, which means that if you're a policyholder, you also are a part owner in the company. And that's where we're seeing dividends, right? So whole life policies grow through dividends. And a dividend basically represents when that insurance company does really well, they share some of that profits back with the policyholders, and that's what goes into growing the cash value. So dividends aren't guaranteed, but usually the top companies will have a long history of giving out dividends for over 100+ years. And then the other major difference with whole life that you can see is the structure of it. So most of the costs to the insurance are upfront and less on the back end, right? Like on the flip side with universal, that's increasing over time. So as a result, there will be a guaranteed death benefit and there will be a guaranteed cash value. So as we move from left to right, we can see that we're starting to get more and more guarantees. Next, this is just another way to look at the different types of life insurance. So with term, that first, the simplest form, we have a level death benefit for a particular period of time. That cost of benefit is going to typically rise over time as you get older. So that's going to be represented by that red mortality cost line. And you can see, most term products, it's going to be increasing. Even for if you have a level term product, usually they just average out this curve that you see here. And it only yields a death benefit, no cash value. In contrast, when we look at whole life, that really provides 3 guarantees. First, it has a guaranteed level cost that cannot rise during the life of the policy. Second, there is a guaranteed death benefit that contractually can't go down and actually is increasing. And then third, it has that guaranteed cash value that's going to grow over time without incurring tax and is accessible and liquid all along the way. And then last but not least, we have universal life. And this is built on the rising cost of structure, similar to like the term, in that first graph there. There is a level death benefit. There is also access to cash value. However, if these universal life policies are only funded for a certain level target premium, at some point in time, again, if those costs of insurance are too high, it's going to start eating away at that cash value, which is why we start to see it curve back down if it's not managed correctly. So these, again, is just another way to look at the different types out there. And then Chris will dive into the landscape of where people are positioned today with these policies and ideally which one we would want to be using for that same concept of being your own banker.
Yes, thank you, Roxy. So when we look at where life insurance trends are today, whole life, again, is the original form of insurance. Term came around a little bit later than that. And then you'll see the rise of current assumption or interest rate-based universal life came about in the 80s. Very new product, all things considered, about 20 40 years old. And then with the rise of the stock market came this rise of the variable universal life, the green line, being invested in the market. And sure enough, it lasted long enough where the dot-com bubble burst really destroyed that whole trend of variable life, and you see it's never recovered since then. That gave rise back to this idea of guaranteed universal life in this universal life chassis. And in 2008, 2009, when everything went bad, interest rates went down, the stock market went down, we see the most recent trend on the market being the rise of index universal life. There's a lot of class action lawsuits going on about those policies today. So just be wary. If you ever have questions, we're happy to look at it for you. So going back as far as looking at where does the landscape of where most of it looks something like this. Whole life again being the most popular because of its guarantees, adding up to really almost as much as all other universal life product sales. And this is taken straight from LIMRA, the life insurance marketing, research and development. So why is something like life insurance cash value, and how important really is it, and who uses it? The reality is used by people who understand wealth building and wealth creation. For example, does anyone know what the largest bank in the United States is? No guesses? It's Chase, JP Morgan Chase, right? If anyone knows what the second largest bank is, it's actually Bank of America. So we just went online and looked at the FDIC website. Anyone can go in there, look at the balance sheet of these banks. And interestingly enough, what you'll see is, right, this is Bank of America. You'll see that in terms of real estate, these are in thousands of dollars, of course. In terms of fixed assets, buildings, leases, properties, other properties that they own off of not part of their operations, that's about just shy of 20 million over there that we see. And then there's actually a line item down here at the very bottom, life insurance assets. There's a whole industry that they call it BOLI, BOLI, bank-owned life insurance, and COLI, COLI, company-owned life insurance. They own tremendous amount of life insurance on their executives, on the board of directors, and this is true for all Fortune 500 companies, large publicly held companies, banks. There's a whole industry. In fact, you'll even see in this case that if you did the quick math, interestingly enough, the life insurance assets are larger than all the bank-owned real estate fixed assets, as well as other real estate assets that are owned. So I just wanted to show that to you because it gives you a sense of they're very intimately tied together. The number is fairly close, but you'll notice that that life insurance asset is actually larger than core tangible assets that even a company like Bank of America has. So if someone were to ever look at a life insurance policy, the question is like, what are you really looking at? How does it work? What are we looking at? So let's take a moment to dive into this, and I'm going to make it as hopefully simple as possible. First things first, you have to figure out if you qualify. So over here, we have a 35-year-old female who got a preferred health rating. There's many different health ratings. I'm using someone who's slightly above average. Someone who's younger will typically fall into this category. They could get better. They could get worse. Keynote for people who are in the military, it is not uncommon for them to get non-smoker or declined commonly, especially if you're looking to do this when you exit the military. Just keep in mind, as you file your VA disability claim, the VA and you want to paint a picture that's severe enough that you can make a claim on your VA disability benefits. It's a great benefit. I'm not saying don't go for it. I'm saying you should make sure to plan strategically around this and get these policies prior to that, because it may that you get a lesser rating or you may not even be able to get it at all. So I just want to put that disclaimer out there. We work with many service members, and it is a constant issue that we have to be proactive in thinking, and that's why you guys are all here today, because you want to be proactive in that. I've taken a plain vanilla whole life policy, I just said 10,000 a year premium, that equates to $733,000 and 3333 of death benefit. And so here we have this illustration that's broken up, right, into guaranteed and non-guaranteed. So we can see here, if we look at this illustration, you pay your 10,000, your contract starts to grow, and then interestingly enough, right, you spend $30,000 to miraculously obtain 5. Okay, is that the rest of the story? And the answer would be no, right? The reality is there's a non-guaranteed column where you can contribute more and the company pays you out interest and dividends as an owner in their company. And that then starts this whole non-guaranteed basis where you start looking across the board, right? You see you have cash value, total, death benefit that continues to grow. So how do they calculate this? What they're doing is they're saying they're getting their guarantee, column A, plus column B. This is what the dividends go back into dividend reinvestment to grow the policy, and that equals your total cash value. So if we looked in year 10, 65,000 is your guaranteed cash value, plus an additional 10,500 of growth is 75,000. Same thing down here, 115 plus 40 is 155. And all the while, we get to see there's this increasing benefit that comes along the way for your family. Now, this is the plain vanilla that we typically see. This is not what real estate investors, of course, would want to see or use. You don't want to see that you put in money and you don't get anything out of it early on. So let's just take this one step further and say, let's say we have the same individual, a 35-year-old female, same health rating. We did the same $10,000 a year, but we will notice that in exactly these two policies, one starts up at $0, the other starts at $5,800. That's interesting. If we look a little bit further down the line, 5 years from now, the column on the scenario 2 on the right has $45,000 available, same 10,000 going in. The one on the left has less than half of that. And then we go 5 years out from there, scenario 2 still has more. 15 years out from there, scenario 2 still has more. Same dollars going in. There's many different types of insurance products. There's many different ways to create one. So we'd tell you guys to heed caution and always to talk with a professional who really understands what your purpose of this policy is. Because you can see if the purpose was to have more death benefit, well, interestingly enough, we could create a policy that starts off at more death benefit, maybe in the long term, slightly less. But then you also have so much access, so much easier access to your deposit earlier. So that's one thing. If I were to go one step further and say, okay, well, let's say we did this plan for 25 years. And over 25 years, $10,000 for 25 years, and then you stop is $250,000. This is that exact same scenario 1, who has $0 year 1. This exact same scenario 2, that has $5,800 available, so 58% access to their funds in year 1. But what if you sold a property and you needed a place to park the money and you wanted to have it start doing something better for you, maybe not in the super short term, but in the overarching long term, and the same $250,000 goes into this over time? How does this benefit, number one, your family? And then how does it also benefit in terms of the percentage of access to cash value that you would have? So here we'll see here, of course, different dollars going in at different time periods. And then we'll also notice that this one has significantly more life insurance. We actually need it to, in order to overfund the policy as it is. This is called, really hyper overfunding early on. And then what you'll notice is that as time goes by, even if we look at year 25, same $250,000 went in. This one has 410, this one has 435, and this one has $717,000 with 50% or more benefit for the family. So how is this relevant to real estate? Where we find most real estate investors are, they tend to be in this column 3. They're looking to develop a strategy that cash value can be asset protected. You own 100% of it, whereas in the bank, if you know how banks work, it's based on a fractional reserve. This is why Silicon Valley Bank crumbled. This is why Silvergate crumbled. This is why there's a lot of banks at risk right now, because you don't actually, if you put $10 in the bank, you don't actually, the bank doesn't hold your $10. They hold 10% $1, and they lend out $9 to car loans, mortgages, business loans, and they're hoping to get more interest on the loan and give you back, hopefully, something in return. A lot of banks like Bank of America, you'll be happy to get 0.1% interest, right? It's almost insulting. But that's how it works. In this type of policy, you own 100% of it. As Roxy said, people are able to, in year 5, 250,000 went in. Let's say there's a deal that comes up, multifamily home, investment property, real estate that you choose to buy. You can either withdraw this money, or you could, ideally, you'd want to take a loan from it. And it would just be like accessing a home equity line of credit where you can direct one-to-one collateral. The policy will continue to grow and receive its dividends and interest, but you could use this funds now to be able to do anything you want. Doesn't have to be real estate. You can buy a car if you really want to. We have some clients actually who have, because they've asked us, well, I'm going at the car dealership, the car loan is 8%. If I borrow from my own policy, how much interest would I have to pay? In the current fixed environment for the contracts we look at, the interest rate for the first 25 years is guaranteed to be 4.71%. After 25 years, that interest rate actually goes down to 3%. So you could overfund a policy. Rather than pay 8% interest to car financing, you could actually just take out a policy loan for 4.71%. You only have to do on these policies interest-only payments, just like a home equity line of credit. Interest-only payments till at the time that you want to pay back the policy. And that's what we actually find a lot of people, especially in the syndication limited partnership world, is, especially nowadays in the last 2 years, we work with a lot of operators, the GP, general partner side, and they're looking actively for the optimal deals, but they don't want to jump into something just to jump into something. So what do you do as these projects idle by? People like to keep their money in a place that's going to benefit their family, be asset protected, continue to grow tax-free, and to be able to, at any moment in time, have the money returned back to them as a loan or as a withdrawal to be able to do any investments. And so as a deal exits and you get your great return, you can turn around, deposit it back into your policy, and have it continue to grow.
Hey, Christopher, we have a few more minutes. This is super fascinating, though. Oh my goodness.
Yes. And that's actually what we had for today. We kind of wanted to stop there and just make sure, were there any questions? I know we went by really fast, but that's a little bit about leveraging. You know, we can talk even more detail about leveraging, perhaps in a different session for someone who wants to go things more advanced. Thank you, Eugene. But this is the time. If you have some questions, we can also stay back a little bit if someone else wants to stay behind. But any thoughts, questions, or experience that people have?
I do have a quick question. Now I'm curious to know, what is the interest rate as when you borrow from your cash value? You mentioned that you could value in like a HELOC. What would be the interest rate? Is that market rate, or how's that?
Good question. It's fixed. So you can do a variable version. Typically, most people won't in these types of policies. So most people go with a fixed rate. The fixed rate would be based on when you got a policy. So if you got a policy maybe 10 years ago, the fixed rate is closer to like 7.2% to 7.25%. Today, for people who get a policy today, the interest rate is at 4.71%, locked for 25 years, and then guaranteed to decrease after 25 years to 3%.
I see. And this is the will not have like a balloon payment in which way you have to pay. You mentioned that it will be only interest only. So as you pay, when is the time that then you pay what you took? Let's say I took out 10,000 at a 4.7 interest rate. I'm paying interest only for what amount of time, and when do I actually get to pay what I borrow?
Yeah, great question. It's annual interest only payments. So
Mm-hmm.
every year your policy renews, they would say this is your new annual premium, whether it's 0 or 10,000, however you structured your policy. And they would also say if you have an outstanding loan, please also pay the loan interest to renew your policy. Now you could technically take a loan from your cash value, if there is any remaining to be loaned against, to pay the interest. And some people do that as well. For example, let's say I'm in year 5, I have a $100,000 loan, I have a $4,700 interest bill. I could say, could I just take $4,700 from my policy this year? So my loan will now be $104,700 and not have to pay the interest out of pocket? The answer is yes. Of course, in the following renewal, your interest will be a little bit higher because now your loan amount's based off of about 105,000 for easy numbers, right? So it will start to go up in that way, but as long as you pay your interest only payments, they will never have a balloon payment. All they simply say is that if something did happen to you and the death benefit is paid out, the insurance company is at right to be collecting their loan amount first, and they'll give the remaining death benefit to your family tax-free. So in
I see.
that
So it
case,
gets deducted. Go ahead. Sorry.
oh, just to summarize that, if you had a $100,000 loan out in year 5 over here, and there was a $2.5 million benefit, if you passed away, the life insurance company would say, just give us our 100,000 and your family will receive $2.4 million.
Right. Wow. Wow. That is awesome. Thank you. Thank you. I appreciate it. Thank you. Yeah.
Christopher, we have some questions in the chat here. The first one is about premiums for whole life insurance. Someone says they hear it's kind of expensive. Like, what is maybe the smallest amount they could contribute to whole life? And I know that probably is a hard question to answer because I'm sure the answer is it all depends, but I'll turn it over to you for that.
Yeah, it depends on age when you get it. So this is also a gift a lot of parents or grandparents give to their kids. It used to be back in the day you buy like, government savings bonds, but as interest rates have come down, they're really not very attractive anymore. But whole life has continued to stand the test of time of being this great asset as well as gift of insurability for families to start off when they're of age. The smallest policies you can get are typically around $25,000 for most quality companies. And I know I see that as another question. But you can get policies as small as like $10,000. But again, that $10,000 benefit will be based on the premium will be based on your age. So you can imagine if a 5-year-old were to get a $10,000 policy, that would look very different from a 50-year-old getting a $10,000 benefit policy. They're both going to be fairly small, but these can really be designed as small or as big as you want. The challenge with going too small is if you wanted the opportunity to do this, let's say you did sell a property and like, I want to put $100,000 into my policy because right now I just don't know what to do with the money yet. Let me talk to Whitney, let me talk to Chris, let me talk to someone to figure out what do I do first. I might want to do some real estate investments. I just want to learn more. Either you stick it in the bank, your checking account, and that's it. But if you have too small of a policy, what the insurance industry has said through IRS guidelines is if you overfund a equivalent policy too much, it'll lose its tax benefits that it receives by the IRS, and it'll be viewed as a complete investment and taxed as an investment, which you don't want to do. So it does need to be structured with some sort of goal or end in mind because it may not be suitable to get the smallest policy. That's exactly why we do see here, I've structured it in a way where it's big, and then I drop off an additional benefit and just let it sit there and continue to grow. There's a lot of complexities behind it, but this is what we do day in and day out. As far as the quality companies, are typically going to be 4 main mutual insurance companies. Guardian Life, New York Life, Northwestern, MassMutual are typically the four largest you'll see come up. They're probably a distant fifth would be like Penn Mutual. If you're not looking at one of those four major companies, I would highly recommend you to talk to us. The only one that is proprietary that we do not have public information to is Northwestern Mutual. Northwestern Mutual has a policy where Northwestern Mutual policies can only be serviced and sold by Northwestern Mutual agents. So you can imagine if you're a Northwestern Mutual agent, you're probably only going to show Northwestern Mutual to your customers or potential customers. Whereas for us, we're happy to shop the universe of whole life policies, and we can compare. We've seen some people with Foresters or Gerber or anything, we can show you why you would probably want to go with one of the strong four companies versus other companies. Like USAA has a whole life, State Farm has a whole life. Some of them may be non-dividend participating, like USAA is now a non-dividend participating whole life product. It's still whole life, it still has its guarantees, but if you look at the equivalent policy, they will not perform the same. Not all policies, again, are created equally.
Wow, that's so interesting. Thank you for that. We have time for one more question here. Let's see. We have one individual that says they have an IUL, have had it for
Mhm.
6 to 7 years. They think about canceling and they'd like to speak to you more about it. So I'm sure we'll send out your contact information, and maybe you guys are open for people to contact and talk about whole life, I'm sure. And
Yes.
then we have a question here. It says, can you list the 4 insurance companies? Oh my goodness, there's so many questions popping up here. We can send those out. And then someone asked, why is Penn a distant fifth?
Yeah, that'll be more of an in-depth conversation, but in short, as different companies look to scale and gain market share, as you can imagine, they try to undercut their competition or look better in the dressing window so they can attract more customers. Penn Mutual is in a current situation where the industry at large that is understanding of it, we have belief that they're really trying to just scale and grow and look good on paper for clients to win market share. But anyone else who's in the industry, who's in the know, that does the analytics, will tell you that they don't seem to have sustainable growth, and they can't actually maintain the projections that they show to their clients. The most recent company that was probably a distant sixth at the time was Ohio Mutual, and they actually they crumbled upon their financial model, and they're basically saying that you're not guaranteed dividends anymore, and it's going to be based on some random formula, but you may not receive dividends for the first 10 years that you have your policy. So you can imagine if you bought a policy and now you got news that, oh, by the way, all those projections were wrong. We're actually not going to give out dividends because we were a little bit too aggressive in our projections, may not be suitable. And so we have a lot of clients who have come to us because of that recent event, but they were considered a distant sixth, but now they're nowhere even in the conversation because they're as good as a non-participating dividend whole life policy. So Penn Mutual likes to show very aggressive, but people who have been in this industry a lot and do analysis, we don't believe that they can be sustainable, and we wouldn't be surprised if in the future they try to get acquired by private equity or something. So it does have that fact pattern of what they're doing to grow in order to be bought out. It has a lot of fact patterns in that way. So just be careful. Again, we can take a look at it more carefully and show some more intimate details, not just on those 5 companies, but we could show you a list of 20 different companies. Not all of them are mutual. Some can be stock, and why. You can, when you look at their underlying financials, you can see how they're really managed as an insurance company.
Right. Wow. Thank you guys so much. Your breakdown of, the different policies and how those pay out was super helpful to me personally. Like, I really liked how you guys showed us how we can leverage life insurance, you know, the cash value piece of that was awesome. And so if anybody wants contact information, this is the best way to reach you guys here on the screen. Thank you guys again so much for coming. We'll go ahead and share a few administrative things to close out our formal portion. And then if you guys want to hang out, everyone will have some people hanging behind after we close the formal portion. And if you have any general questions about real estate, or if you want to ask the guest speakers any more questions, feel free to do that. So let me make a few announcements here. When we do close this out, when you do exit the Zoom, we will prompt you to fill out a survey. If you guys could fill this out, it would be super helpful to us. We want to make this valuable to you, these events that we're doing. And so it'll just ask you some questions on how we can make it better, what you found useful. So you'll do that when you log out. That would be great. Another thing, these are our next 2 sessions coming up. So July 13th, we will be discussing how to print 3D real estate in 2024. I think Anne or her partner will be here talking about 3D printing real estate, which is going to be super interesting. Great topic. On the 14th of September, we'll be talking about how to finance a deal in Japan. We have lots of people stationed in Japan, so this is always a popular topic. With that, that will close out our virtual series for this year, those last 2 programs. And I don't know why my slide is we have a Facebook group, so if you guys want to stay connected with the most recent updates or changes or information for our following virtual series, please join our group. It's a great way to connect and network and stay speaking with other people in this area. The QR code here will direct you to that. Let me move my link here. So if you want to take a picture of that QR code, that'll take you directly to the Asia Pacific Active Duty Passive Income Facebook group. We're all on there chatting all the time, so love to see you in there. If you are interested in hosting, if you like what you saw, we do have a few empty locations that we don't have hosts or a meetup group. So in Japan, we have Masawa, Camp Zama, Sasebo. In Korea, we have Kunsan, Camp Walker, Camp Carroll. Those are all looking for meetup hosts. Please reach out to any of us if you're interested in doing that. Would love to talk about that and get that going in those areas. And finally, we have saved the date for our next conference. This is going to be next year, spring break timeframe for DODIA, April 4th through 5th. This will be the Asia Pacific Real Estate Investing Conference at the Hyatt Regency in Guam, hosted by and run by our very own Anne De La Cruz. So they just wrapped up this year's conference in April, and it was by all accounts a resounding success and just an awesome opportunity to network again here in the Pacific. So save the date for that. With that, thanks again to our speakers. Thank you for everyone to taking the time to come learn with us today. And thank you to everyone behind the scenes who volunteered to set this up. It takes a lot to coordinate all this. With that, we will close the formal portion of our event today. And if anybody wants to stay behind for questions, please feel free to do so and just hang out. Thanks, guys.
Thank you guys all for being here. Woody, would you mind going back to one slide? I just want to add to the summit information. And so we threw this together as a team in less than 2 months. Everyone thought we were crazy, and quite frankly, I think it was crazy. But it was a resounding success because here on Team Asia Pacific, we've been doing this, offering these virtual how-to series to our communities for 2 years now. So it's been very virtual, right? And so the reason why we did this summit was a way to take our online community and find a way for us to meet in person. Because in my personal experience, nothing beats in-person connection, right? We've been doing all this virtual stuff. COVID kind of threw us in that direction, and it's been great, but it's not the same as in-person engagement. And so I think that's why the event was so successful, because many of us have yet to meet in person. And so coming together, it was just really incredible. And so definitely take note that we'll be doing this again. I think as we finish day one, our people are already asking about the next date. And so, yeah, we'll be doing it over day of spring break so that people, when they're already looking to travel, we're just saying, hey, why don't you come to Guam to get real estate investing information, to be able to network, engage, and learn. And we're actually going to have activities. The main event will be the 4th and 5th. But we'll also have activities throughout the week to help make it so that it truly is a family-friendly real estate investing conference and vacation and all the other stuff all rolled into one. And so just want to be able to share that with everybody. And I think we need to adjust our recording. I think we're still recording.
Yep. At this time, I will stop the recording. Thank you so much, Christopher and Roxy. It was a great presentation, and thank you all for being here. So we'll continue. We'll stay on a little longer. So if you guys have any more questions, I don't know how much longer they will stay here, but this time I will stop recording.
Awesome. Thank you so much, Ari. If I could just jump in.